Let us go back there and start with your money. Bank of America's latest mutual fund survey shows that mutual fund managers have not been this bearish in 30 years. That's right. Investors are the most negative they have been since 1995. 82% of those polled expect the global economy to weaken, and a record number plan to cut exposure to U.S. stocks, in part due to high uncertainty surrounding American trade policies. But one does wonder, could that actually be good news for the markets, or does it really signal kind of a gloom and doom to come? Jeff Kilburg is founder and CEO of KCAM Financial. He is on set. And Jason Ware is CIO of Albion Financial. Jeff, also a CNBC contributor. Jeff, good to see you on set, man. I will start with you. This mutual fund survey, right? Like the fear and greed index, super negative. Mutual fund survey, worst in 30 years. Call me skeptical, but that's kind of when I get interested.
It's like an alarm.
You're supposed to buy when everybody else is selling. That's what I'm told.
I don't think it's equal to the VIX being over 60 being the signal to buy, Sully, but I think it's fascinating to see that just 2 months ago in February, we saw a data survey of the most bullish. So when you see sentiment swing with the velocity it has, yes, it's hard to capture that emotion, but I think investors right here, right now, have to continue to think through because remember, Sully, we're about 12.5%, 13% higher off that recent low at 4,800 in the S&P 500. And every day we have a higher high, and people are continuing to be pessimistic.
Well, they are, Jason, I think because, and who can blame them, every sort of muttering or uttering about a tariff, the market can turn. I mean, one wrong word or one wrong statement or one right word or right statement, and markets go up or down 5%.
That's right, Brian. And I think that's exactly why we're seeing the survey data that we're seeing. Look, everyone is bearish on the macro right now, and understandably so. With these tariffs come great uncertainty, and that great uncertainty is causing strategists and investors and analysts to mark down their estimates of growth, while at the same time the positioning is a little bit less bearish. Why? Well, the answer is last Wednesday. We saw what happens when the one person that controls the outcome here tweets something that is bullish, and nobody wants to be on the wrong side of a massive move in the market. Will this be a V-shaped recovery when that recovery comes? Maybe we're already in it. I don't know. I'm not smart enough to be able to call short-term moves. But being off sides, either short or sitting in cash, when that tweet comes and when these tariffs are resolved, investors aren't willing to position that way.
Jason, let's go back to that point, okay? I want to stick with you because I think I heard Scott Wapner and his team say kind of the same thing, which is that the risk is to the upside. What I mean by that, it's not personal opinion. To your point, it's that if the president or Bessent or somebody else came out and said we're going to kill the tariffs or ratchet them back or delay them again, whatever it is, stocks are going to rocket higher. And to your point, nobody wants to be in that position where they miss that move.
Yeah, and I think that's expressed in how quickly the bear market was. And make no mistake, this has been a flash bear market. We saw the S&P 21% peak to trough, small caps down 30, the NASDAQ down 27, momentum down 25, mid caps down 26, the Mag 7 down 34. So this has been a bear market, and it happened very quickly, not unlike COVID. And so I think the recovery can happen quickly if we get that tweet or even just incremental improvement. Markets care less about the absolutes of good and bad and more about whether things are getting better or worse. And any deals that come in the weeks ahead will be progression toward.
Jason, I think you bring up a great point. And what's interesting is that we saw that deleveraging that happened. If you remember, Sully, just a week ago, Friday, we saw the most put options ever bought in the marketplace. What happened? The subsequent week, we had the best market we've had in quite so many years.
How can we have both things be true?
Because of the velocity of this acute move. We talked about this flash correction, this flash kind of crash, which allowed people to really hedge, but it was hedging too late. And we've talked a lot here on Power Lunch, Sully. The time to hedge is when the VIX is under 15. Not when it's above 60. So I think
expensive.
So to your point, way too expensive. So this moment right here, right now, the risk is to the upside because people are either sitting in cash or they're so hedged, they're going to have to cover those hedges. They want all that insurance that they bought go to zero. And you're seeing the 10-year note soothe some of the nerves today. So every day we're inching up a little bit higher, close to that 200-day moving average in the S&P 500.